Imagine your friend, Peter, has the most amazing pizza recipe. People like it so much, they keep telling him he should consider opening a shop. So Peter finally decides, I'm going to open a shop. But there is one problem. Opening a shop costs money. He needs to buy ovens, tables, chairs, and ingredients. Let's say Peter needs $1,000 to start, but he has only $500. So Peter has two options. He could go for a loan, or he could ask friends and family to help out. When Peter considers the two options, he thinks to himself, if I go for a loan, it will accumulate interest, and if the business fails and I'm not able to pay back, I'll be in serious trouble. On the other hand though, if I convince friends and family to give me the money I need, I can cut a deal with them. If the business makes a profit, they get a reward. And if the business fails, everyone counts their losses and moves on. No one will be chasing me for their money if things go south. So Peter pitches the idea to you, me, and his neighbor Sarah, and convinces us to give him the extra $500 he needs. But the three of us, knowing what Peter is capable of, we believe Peter has the potential to give us a good return on our money. I mean, everyone loves Peter's pizza, so we agree to help. You give $200, Sarah gives $200, and I give $100. And just like that, Peter has the $1,000 he needs. At this point, we now own a piece of Peter's pizza shop. That makes us shareholders in the newly created company. And that piece we own individually is called a share or a stock. Yes, that is the whole idea of what stocks or shares really is. But it gets more interesting. Since Peter contributed half of the money and the rest came from us, if the shop makes profit, it will be split according to how much each person contributed. So at the end of the first month, for instance, if the shop makes a profit of $1,000, Peter gets half, then the other half is split amongst you, me, and Sarah, according to how much each of us contributed initially. That payment you get just for owning a piece of the company is called a dividend. So in a nutshell, you own a piece of the shop which is worth $200, yet you get money every month depending on how much profits the shop makes. And by extension, if the company expands, say it opens another shop or a branch, you still own the same share in all of them. So indirectly, the value of your shares has increased and you get more profits coming in. But wait, it gets even more interesting, trust me. But before we go deeper, please know that this video is for educational purposes only. Don't consider this as financial advice. Now that is out of the way, let's get back into the video. At this point where business is booming, people will naturally want to have a piece of this company as well. They know that if they get in now and things keep getting better, they will make even more money in the future. Remember that share you bought for $200? The company now has 2 branches and is doing very well. So someone comes to you and says, although your share is worth $200, I am willing to pay $200 for half of your share in the pizza shop. Now, why will he do that? Because he believes this company has the potential to open even more branches and increase the value of his contribution someday. So you sell half of your share for $200, and just like that, you've got your original money you contributed back into your pocket, and you still own a piece of the business, although it's not the same size as what you had before. Whatever happens next is pure bonus regardless. But here's the thing, not every business keeps booming. What if Peter's oven breaks, a blogger posts negative news about the pizza shop, or a new pizza shop opens next door with lower prices? People will panic because they feel the pizza shop might not be profitable as it used to. Suddenly, fewer people want to own a piece of the company. The people who own shares want to sell before things get worse. When a lot of people are selling and fewer people are buying, the price will drop naturally. Prices go up when people are excited and want to buy. Prices go down when people are worried and want to sell. It's basically a giant game of how people feel about businesses. Now, let's bring it home. Now that we know what a stock or a share is, let's look at what the stock market is all about. Just like the name suggests, it's a marketplace like any busy market you know of. But instead of selling groceries and fabrics, people are buying and selling tiny pieces of companies like Coca-Cola, Nike, and in our case, Peter's Pizza Shop. These companies rip out chunks of the company, split it into tiny pieces, and sell them as shares to the public, that is you and me. And the stock market is simply the place where all of the buying and selling of these shares happen. In America, the market is called the New York Stock Exchange and Nasdaq. In Ghana, we have the Ghana Stock Exchange. These are the official marketplaces where shares are sold and bought every single day. Let me know in the comments what the market is called in your country. I'm curious. By now, you are probably thinking, this sounds cool, but how do I actually buy shares? Do I just walk to Tesla's office and hand them money for a share of the company? No, not exactly. You use something called a broker. This is just a fancy name for a middleman. They represent regulated companies that have been given the authority to trade on your behalf. This is how they operate. You tell them, hey, I want to buy 2 shares in this company. They go into the market, find someone selling, and make the deal happen. Same thing applies when you are selling. You can't buy shares without them. No. Some of these middlemen have made it quite easy these days to buy shares. You just register on their platform and place the order for them to buy the shares for you. But make sure to do a proper research on the best brokerage company before you jump in. I will be making a video on that soon. You can find it here when it's published. But I have to be honest with you. I would be lying if I said the stock market is just free money all the time. This is not a get rich quick scheme. Remember, prices can go down too. If you buy shares for $100, for instance, and the price drops to say $60, and you sell, you have lost $40. That's the risk. This is just one example of the risk and mistakes newbies make when investing in stocks. I have a simple guide that will help inform you about some of these mistakes. You can check them out here or visit my channel for more informative videos on investing. If you have any questions, do well to comment and I will address them for you. And please subscribe if this video was helpful to you. I'll see you in the next one.